Scene script. Have you ever thought about how to become a millionaire through index fund investing? If so, you're in the right place. Index fund investing is a powerful tool for wealth accumulation, but what is it exactly? Well, index funds are investment vehicles that aim to mirror the performance of a specific market index. They're like a basket of different stocks or bonds, providing a high level of diversification. What makes index funds particularly appealing is their passive management style. Rather than trying to beat the market, they aim to match it. This method cuts down on trading fees and keeps costs low, which can significantly boost your long-term returns. But the benefits don't stop there. Index fund investing offers a relatively straightforward and hands-off approach to investing. It's a popular choice for both seasoned investors and those just starting their investment journey. The beauty of index funds lies in their simplicity and accessibility. Whether you're investing a few hundred or several $1,000s, you can gain exposure to a wide range of stocks and sectors. This way, you're spreading your risk across many different investments, rather than betting on a single company. By the end of this video, you will have a basic understanding of how to start investing in index funds. So, let's dive in and explore this exciting world of index fund investing together. First things first, what exactly is an index fund? You may have heard the term thrown around in financial circles, but let's take a moment to really break it down. An index fund is a type of investment vehicle, but it's not just any vehicle. Think of it as the reliable, fuel-efficient car in the world of investments. It's designed to match the performance of a specific market index. This could be a broad market index like the S&P 500, or more specialized ones like the NASDAQ 100. The key is that an index fund aims to replicate, not outperform, its chosen index. But how does it do this? Well, an index fund holds the same assets in the same proportions as the index it tracks. So, if a particular company makes up 2% of the S&P 500 index, that company will also make up 2% of an S&P 500 index fund. This is what we mean when we say an index fund is passively managed. There's no fund manager making day-to-day decisions about what to buy and sell. Instead, the fund simply follows the composition of its chosen index. This passive management is one of the reasons why index funds tend to have lower fees than actively managed funds. The lack of active trading means less work for fund managers, which translates into lower costs for you, the investor. It also means that index funds generally have a lower risk profile, as they're diversified across a wide range of assets. Now, don't be fooled into thinking that passive management means you're settling for less. On the contrary, numerous studies have shown that over the long term, index funds often outperform their actively managed counterparts. Now that you know what an index fund is, let's move on to how you can start investing in one. You're probably wondering, how do I start investing in index funds? Well, the journey to index fund investing begins with a thorough assessment of your personal financial situation, life goals, and risk tolerance. It's important to understand your investment horizon and how much volatility you can stomach. Remember, investing isn't a one-size-fits-all game. It's a personal journey tailored to your unique circumstances. Once you have a clear understanding of your financial standing and investment goals, the next step is to choose the right index to track. There's a multitude of indexes out there, each offering a different blend of assets. Some indexes focus on large-cap stocks, others on small-cap stocks, and some mirror the entire market. Your choice of index will depend on your investment goals and risk tolerance. Now let's talk about brokerage accounts and investment apps. These tools serve as the gateway to the world of index funds. A brokerage account is an investment account you open with a brokerage firm. Through this account, you can buy and sell index funds, among other investments. And on the other hand, investment apps are mobile platforms that allow you to manage your investments right from your smartphone. They're convenient, user-friendly, and perfect for the modern, on-the-go investor. Once you've set up your brokerage account or investment app, you're ready to start investing. But remember, investing isn't about making a quick buck. It's about growing your wealth over the long term. That's why regular investing is key. By investing a fixed amount at regular intervals, you can take advantage of market fluctuations and potentially improve your returns over time. But investing is not a set-it-and-forget-it endeavor. It requires careful planning and regular monitoring. You need to keep an eye on your investments, review your portfolio periodically, and make adjustments as needed. Remember, the financial markets are dynamic, and so should be your investment strategy. Investing in index funds is a straightforward process, but it requires careful planning and regular monitoring. So, get started, stay disciplined, and watch your wealth grow over time. Like any investment, index funds come with their own set of risks and rewards. Just as a skilled chef balances the flavors in a fine dish, so does a savvy investor weigh the potential risks against the rewards when considering an investment. In the case of index funds, the scales can tip favorably in the hands of a knowledgeable investor. Let's start with the risks. As index funds are designed to mirror the performance of a specific market index, they are subject to the fluctuations of that index. If the index falls, so does the value of your investment. Also, not all indexes perform equally well, so the choice of index fund is crucial to your investment success. However, it's important to remember that while markets can be volatile in the short term, they have historically trended upwards over the long term. This is where the power of patience comes into play. Investors who stay the course, weathering the ups and downs, can potentially reap substantial rewards. This leads us to the reward side of the equation. One of the biggest rewards of investing in index funds is diversification. By mirroring a market index, an index fund spreads its investments across a broad range of companies or bonds, reducing the risk that poor performance in one area will significantly impact your overall portfolio. Moreover, index funds are passively managed. This means they do not require fund managers to actively buy and sell assets, which often leads to lower fees compared to actively managed funds. These savings can significantly boost your returns over the long term. In addition, index funds offer the chance for consistent returns over the long haul. While they may not outperform the market, they also won't underperform it. For many investors, this consistent, steady growth is an appealing reward. In sum, index funds present a balanced mix of risks and rewards. They offer the potential for steady long-term growth, while their diversification reduces the risk of significant losses. However, like any investment, they require careful consideration, and the choice of index fund can significantly impact your returns. Understanding the risks and rewards is crucial for making informed investment decisions. By doing your homework, practicing patience, and maintaining a long-term perspective, you can tip the scales in your favor and potentially reap the rewards of index fund investing. Let's recap what we've learned today about becoming a millionaire through index fund investing. We started our journey with an introduction to index fund investing, where we discovered that these are investment vehicles designed to mirror the returns of a market index. They are passively managed, meaning that the fund managers aren't actively deciding what to buy and sell. Instead, they own the same assets in the same proportions as the index they're tracking. We've also learned that index funds are popular due to their low-cost structure and their ability to provide diversification. This makes them an excellent choice for beginner investors, as well as those who are looking for a hands-off approach to investing. Next, we delved into the mechanics of investing in index funds. We discovered that it's crucial to assess your personal situation, life goals, risk tolerance, and budget before choosing an index fund. We also learned that there are different types of indexes to choose from, and that it's important to research the assets under management, fee structure, ease of trading, and the background of the managers of each index fund. Moreover, we explored the risks and rewards associated with index fund investing. While they are generally considered to be a safer investment option due to their diversification and low fees, it's important to remember that all investments carry some level of risk. However, the potential for long-term growth and financial independence makes index fund investing an attractive option. Lastly, we touched upon the concept of patience and the importance of viewing investing as a long-term game. Investing in index funds isn't about making a quick buck. It's about building wealth over time, and the key to this is consistency and discipline. In conclusion, Index fund investing is a powerful tool that can help you on your journey towards becoming a millionaire. It offers the benefits of diversification, lower costs, and the potential for significant long-term returns. However, it's crucial to do your research, understand your risk tolerance, and choose an index fund that aligns with your investment strategy. Remember, investing is a long-term game. With patience, diligence, and the power of index funds, you're on your way to becoming the millionaire. Happy investing!